This is Justin Pulitzer. This is my weekend review for Sunday, June 12th, 2016. A lot to cover, and I'm going to try and make this video a little bit shorter than usual. We'll see how that goes. Anyhow, I'll start with the VIX. You can see that I had talked in the last weekend video that we were coming down to near the lows. I feel that the VIX has an asymptotic relationship with this, that there is some intrinsic value there, and we got the rally back up. It has been failing at the backside of the old channel, although it is starting to make some higher highs here. I would expect that there's potentially a little bit more of a bump up to come. The vestibule for kind of higher in the VIX is 1785. Anything above there can see a little higher. The caveat being is the 200 MA is right there, so you might have a little bit of a spike into the 18s and then it kind of retreats. We'll see how that goes. I've proposed that we are in a time of more benign volatility like this period, Xing this out here, where we have some brief spikes. We'll see how that goes. There's some events coming up that could potentially kind of throw this on its ear. Obviously, the Fed meeting is this week on Wednesday, and then in a few weeks we have the Brexit. I'm not expecting very much out of the Fed with regard to their interest rate policy. You can see the probability of a hike here is only 2%. July is 23%. September, only 37%. November, 38%. And only in December is it over 50%. So it seems to me the probability of a rate hike is being way taken out of the market. If that were to happen and the Fed were to surprise, I would expect a very large move down in the S&P, but we'll cross that bridge when we get to it. Anyway, like I said, we are getting up to the kind of pass or don't pass line, the backside of this old channel with VIX. We'll see how that plays out. I have created a key here about how to use the VIX, and if you want, you can pause and just check that out here. The dollar. So the dollar had this big run up and then kind of settled into a range with moves above and below the range being unsustainable. There is some good and some bad news here. The good news is we're still in stochastically a pullback mode. The bad news is that we are now making some higher lows and getting back up into range. We broke one downtrend area. We need to see if that confirms. I drew in an unofficial regression line here. So we'll have to see how that plays out. We're coming into that area, and that should be some resistance between there and the gap fill. So after that, I'll probably be looking to make more of a call on where I think the dollar is going. Short term, there is some room a little bit higher, but if we do fall back below these Friday's range, I would think we will likely start pressing back down lower. The bonds. So TLT has now made a new high for this swing. This is technically a breakout. It didn't do it with a ton of conviction, but it is a breakout nonetheless. Higher lows, higher highs. That's usually I guess a more bullish than bearish pattern. I don't necessarily know if we're going to really run hard to the high and to the channel, but it is possible if we keep getting recessionary-like data that we've been getting. I don't want to get into the jobs report and all the ISMs and so on and so forth, but things have not been good, and I think that the world realizes that with the looming potential Brexit, with the Fed on hold, and with sluggish growth, that rather than paying 0.02% in like bunds, I think that's like their 10-year rate, it's crazy, they can still get a little bit more yield, relatively speaking, in terms of the U.S. Treasuries. It's also when people get nervous and they don't necessarily worry about a return on their capital, they worry about a return of their capital. I think there's a lot of fear surrounding foreign locales and where people can keep money and keep it safe with a fairly liquid. I mean, the Treasury market is the deepest market. The U.S. currency, obviously, the dollar is the deepest currency, and I think people feel that they can get in and out of this with relative ease and not have to worry about putting the price up or down on themselves. Anyway, this did get a little bit spiky. Obviously, we had a pretty big run up. Whenever that happens, people start getting the recessionary talk going. After that, usually cooler heads prevail, and they realize that when interest rates go down, meaning bonds rise, there is a PE multiple premium that is commanded by equities. That has been the case here. Obviously, the S&P is trading relatively rich. It's trading 19 times earnings. I've seen a lot of very intelligent people not seem to understand that. They say, oh, the S&P, a market multiple is 15. Usually the truth is, as a market multiples below 10 becomes unsustainably low to the downside, and above 20 becomes unsustainably high to the upside. The caveat being is when you get a PE multiple premium at usually 20, that usually is where market cycles inflect. But interest rates usually are at that point 6%. That was the case in 1929, the case in 2000, the case in 2007. 87 was a little bit unique because of the Paul Volcker and rates, but I don't want to get into that right now. But and then again in 2007. But the interest rates now, we know, are sub 2%, or basically holding on to close to around 2%, depending on how far you go out. And we are nowhere near that 6%. So that is why the market has remained stubbornly strong, and even the crappy and reduced earnings of companies are commanding PE multiple premiums. When do we have to worry about market crashes? When there is credit fear in the system. I don't want to get into LIBOR and get into a bunch of stuff that most viewers probably don't care about or really have much of an understanding on here, but let's just keep it simple, stupid, and talk about HYG. When you start getting moves like this, people start worrying about credit. A lot of this, I think, was fear over oil and companies that were overextended, and fears that there would be a lot of defaults. There have been some, not as many as people have feared. It's been really in rather weak companies that have did some really kind of, I don't want to say shady things, but didn't exercise the utmost in risk management. And the pattern here still is higher lows and some higher highs. Until that pattern reverses, I'm going to say things are kind of like still kind of okay in credit. I'm curious to hear what the Fed has to say with regard to this. My guess is it's probably going to be something similar, that they're not as worried about a credit crisis. We're basically holding on to the 10-day moving average well above the 200, which is starting to flatten and even bend, and a 50 that is coming up. I would say until you see a 50 MA break, things are kind of still okay. You had a gap and go above the 50. You haven't even been able to retest it. I don't think that there is much fear here right now in terms of credit. Oil, speaking of which. All right, so we reached some big targets in oil. We're a little bit overbought. I had talked about 49 to 52 being the kind of the upward end of this range. We topped out at 51.62. It is pulling back. We're still in the uptrend. I think the 50 MA would kind of be the sort of outsized move in the range for the moment. It would be a channel break, which could potentially be some issues, but we haven't even taken out this hammer low here. So until we start taking out 47.75, I would and 47.26. So this area here, there's really not that much to see. This just looks like a bit of a look above and fail, and we're coming back into range. I still will maintain, I think oil will see higher longer term, but after multiple weeks up, it's not so unheard of to see a bit of a pullback, here being the most extreme. So let's see how the channel low holds. And I'd be looking for a right or right out move here, particularly since we have multiple days down. If it breaks, then we could play the GTFO. So if it loses the channel low and these hammer lows, below the 47.26 to 47.75, then it's a GTFO, and we might have to reassess our view on oil, at least short term. XLE also got a little bit high. We got close to this volume distribution, just pulling back here. Still holding the channel right on it. There's an even bigger uptrend here. So I like put ratios, like buying some up here and selling 2 times out of the money down here near these reference lows and the 50 MA. I think that is a bit of a winning trade if you want to wait and don't really like playing put ratios, meaning buying a put and selling 2 times out of the money, or buying 1 and selling 3, or doing put flies, buying 1, selling 2, buying 1. It depends on how you look. There's a lot of ways to skin a cat here, so to speak. We broke out of the 200-day in quite dramatic fashion. This has been very important. We haven't retested it in a while. It is significantly lower. If this were to really start falling apart, I'd be looking to really get a little bit more aggressive for right or right out trades around the 200 MA. But as of now, I'm just thinking maybe we stop here, or more likely, maybe around here near these reference lows. So XLE just in a bit of a pullback mode. You'd really not know much about this with regard to given Exxon. This has been in sort of a it's been in a bit of an up channel, not a really steep one, but it is getting a little bit overdone. We're still above the big moving, the immediate ones, the 10 and the 20. I'd be a buyer right or right out on the 50 MA for a row test. That would be coming back down to the channel low, this low, and kind of the breakout here. As long as Exxon is above 85.58, I don't really see there being too much to be worried about with regard to oil. If it starts snapping that area, we could potentially slip back to the 83s and 84s. But this was a lot of support, which became resistance, which is now support again. This area was the breakout. I'm going to assume it will remain okay until it's not. I like the idea of selling puts on that on pullbacks. FXI, China. This is a big, important ETF. I want to just show you something that happened and why this might not be as super duper bearish as a lot of people seem to think it is, and it would help if I could zoom in. Yes. So we were in a bit of a downtrend here. That broke. We are now just testing the back side of it and still above the 50 MA. This is very, very key area to hold. If this starts failing, then I think we're going to see the primary trend area. We do have a slightly lower high, so I'm, I guess, a little bit cautious. We weren't able to hold over the 200 MA. So 50 MA was the hold here. I'm going to use 50 MA on the top side of it. Remains, I guess, more bullish than bearish. On the back side of it, remains more bearish than bullish. Keep it simple, stupid. IBB, a huge risk monitor, still in full bear flag mode. Higher lows, but slightly lower highs. Let's talk about what that might mean here. We are below some key areas that I talk about, 275.40 to 271.77. Anything below there remains suspicious to me. The 100 MA is an important one. You can see we gapped below it and went. We haven't been able to sustain on the right side of the 100 MA. This is really, I was about to use some profanity, F or walk territory, so it is just that. We've had multiple days down. These highs aren't particularly, these still are a little bit poor. Pull back, not surprising. So right or right out here with the 100 MA. Above Friday's high of day, I think that could be considered a right or right out long. Below the low of day, a right or right out short. Let's just keep it that simple. Gilead also not really doing all that much. This is sort of a one of the big boys. Bit of a double bottom here, failed breakdown, rally back up, still holding kind of weak. 84.88, we're kind of closed on the wrong side of that. I would say let's use Friday's range here. If you're below, is probably a continued short for a little bit lower. Above the high of day, probably are going to rally. Alrighty, let's see. Some other things I was looking at, like last week, with regard to risk, EEM was starting to look like it was trying to form a bit of an inverse head and shoulders. It didn't break the last swing high, though, to confirm. A lot of people don't seem to understand that you need the confirmation. We didn't get it. Instead, we got a bit of an island reversal, a hanging man. I don't even know what you want to, whatever you call it. You had one of these dojis and then a pullback. Trend is snapped, although we are still above 33.43. We're right basically on the 50 MA. Very key area. You could see here, though, the 200 MA was a little resistance and support, so I'm willing to give it a little bit of leeway, so to speak, but this area really needs to hold. I'd be a right or right out buyer right on the 200, or if we were to hold here, like if we had a bit of a double bottom and this started looking like it was reversing, I'd be a right or right out buyer for a trade. In smaller size, though, I don't really know how to emphasize that since we do have a bit of a trend snap. I would be a smaller size player here, but I will be looking to try it and see how that plays out. Let's get into the major market indices here via SPY, for example. So what to make of the S&P 500? I don't want to get into the history that I usually go through with this. I am, like I said, trying to keep this video a little bit shorter than usual, so we're just going to be right in this immediate time frame. I drew a channel here. We had a bit of a look below and fail, came back up. We got to the channel top. I mentioned on this day it was time to start lightening up. The next day we did get slightly higher. This was a poor high, meaning there wasn't a lot of excess there was no excess in the profile. A bit of a back off. This day was starting to be a bit of a poor high. It wound up, I think, repairing, but I wouldn't say this is a secure high because there's really not a lot of excess, but you did get a back off. Friday was a gap and go below the trend. So where are we now? The way I see it is that this level is the first key one, 208.97. As long as we're above 208.97 to 208.86, which was this bar's low, I'm still constructive on the market making, new all-time highs. It seems like that wouldn't be the end of the auction. And as long as we're above here, it's still kind of the upper of the distributions. If we start getting below there, I'm going to start thinking a 50 MA touch, which would basically just be a 50% pullback in this range, which is currently 207.66. You can see we have 207.97 there, and there's 207.84, which is another key range. So there's a lot of support levels here. It's also kind of getting into a high volume node. I would think that this would be the first stop. You can see this was also a little bit of points of contention along with these highs. This was the failed head and shoulders breakout. So there's a lot of reference levels there. 208.97, 208.54, then the 50% fib. I think this area will be a big point of contention and likely will be some support. If there were to be a further break, then we're looking at the 61.8, around 206.5 to 206.76. That's some key levels. So those are the two major ones that I'm looking at here. If there's going to be some weakness, I like playing put ratios with long those strikes and then short 2 times out of the money below there, very near term. The expected move in SPY this week is $3.58. I'm guessing if it's a move down, it could be a little bit larger. That would take you to roughly 206.49. So look what I said, 206.5, which is the 61.8 of the range. So we would be basically right at the expected move and the 61.8 of the move. I'd be row long right here. I like that as a play. If we were to rally up, that basically takes you to 213.65, which is right above these highs. Yeah, so we're either going to make a higher high this week or come back probably close to the 50 or 61.8 of the range. I don't know. Maybe there'll be some news. Who knows if the Fed does something silly. I don't think we're going to see channel low this week. I think we're going to do something more like see the 50 MA, maybe a press below to the 61.8, and then probably bounce. I talked about there being a narrow window for us to have a pullback. We could be in it. I thought there were 2 scenarios possible. One was that we just continued rallying into the end of the quarter, and then last week they locked it in. Or the other alternative is that there was some type of a pullback ahead of there, and then they kind of rally it into the end of the quarter, likely to new all-time highs. I still am in the new all-time high camp, and I'll show you why. If you go to a 5-year weekly, this chart is rather choppy. You basically had a pullback here. This was like the big move up bar. Then you had a kind of smaller range pullback, and then now it was just sort of a bit of a look above and fail for the moment. If we start losing this weekly, like I said, the 208.86, that was the pullback low here. then I'll be a little bit more skeptical and think that we're going to see a little bit lower. It is possible we just do something like chop for a while, but anytime we have had some spiky moves here, there have been pullback weeks. So we could be in that narrow pocket where we do see the pullback ahead of the end of the quarter, and then there's the window dressing rally into there. But levels, I'm looking to be a buyer in here for right or right out trade, and I like playing put ratios for moves down to that area. Intermittent, before I get into IWM and the Qs, I want to just talk briefly about some of the financials. I get a lot of questions about XLF, for instance. This is still in a downtrend. We got right up to it and it backed off. We now have a trend snap. We're right on a 50. So the 50 and the 200 here are the keys. Anything below there gets a little iffy to me. We could easily see the 22s. And then this could really fill up the triangle. Financials are really highly dependent on higher interest rates just because they've been so badly neutered from the Fed. And I shouldn't say from the Fed with low interest rates, and then also Congress with all the regulations. So we are right where this needs to hold. I would say the max you can see is I would be an interested buyer down here in the 22s for a right or right out move. And then you'll probably could see something set up like the head and shoulders sphere. It would not shock me to see that pattern play out, but I do think that a play down into the 22, at least for initially, would be a good row play, and then play for something like a bounce to the backside of the downtrend line. I'm sorry, the back of the old uptrend line. One of the things that has me thinking we're a little bit iffy here is Morgan Stanley. We are below the neckline of the 26.16. We took out these swing lows, the 25.89, so this is sort of really key levels. It wouldn't surprise me to see a little bit of a bounce back, but we're below the channel. I'm a little bit iffy. I'd be a buyer, though, if we got down to these lows here, like near the 23s or the 22.69. I think I actually have a buy order in at 22.68, something down here near the 78.6. I think that area would likely be an area to buy. So I like playing put ratios if there's any juice in there, but let's see how this plays out. This is looking a little iffy to me. Goldman Sachs is one people are talking about. Oh, one last thing. If there were to be some type of a move up, like a gap up on Monday and go, this would have probably been a false breakdown, just a key thing to look at. I don't necessarily think that that's going to be the case, but is a little iffy. All right, so Goldman Sachs, I've had a lot of people asking me about this. Is this a short? My answer was I thought it would go lower and it would be weak, but it could be a frustrating short. Why? Because you have reference lows down here in the 48s, and you also have a channel low. So I could see this going a little bit lower and then bouncing and frustrating people. A lot of people probably took the short below here, which was the correct trade, but they might be not getting all the bang for their buck. I'm suspecting this gets retested at some point. Just this pattern, I've seen this play out before. It's usually not such an easy pattern to really break down out of. It just tends to be, tend to have these bounces and then moves lower, and it's more in a grinding fashion. That said, we are below the trend. It's iffy below 150, 165, but here you go. You're playing only for maybe for a couple of points down to the channel low and the 148. So that's just my thinking on GS. I think it's weak, but it could be a frustrating short. It might not have as much follow through as people think. Deutsche Bank, obviously, really right on it. Needs to hold here. We are below the last swing low, but this one is the key. The 1530s. This needs to hold. It's looking a little iffy. I don't think that there's as much credit risk in these banks as people think, although there might be. I don't really like to play that game. I just know that the price action has been weak, and I know that they are really crippled from low bonds. Think about how our banks are having trouble making money. These are even worse because they have even lower interest rates. Credit Suisse is now on a new low for the move. This could still even see lower. I mean, it could see the 11s. I don't necessarily know if this is going to be a complete collapse, but it's this is a key level here. I have a drawn in potential trend right on it. So this is really F or walk levels, really key areas for these stocks. Let's get into the Qs. Actually, let's do IWM first. So IWM, I've talked about this. I want to show this on a bit of a longer term chart. 1 year, is that enough? Yeah. This had basically a look below the channel. We've got a bit of a look above the channel. We're coming back into the 14s. As long as this area holds here, the 114.13-ish, these highs, I think that it's still kind of quote-unquote okay. Look at the box low, 114.29. So as long as we are above 114, let's keep it simple, 114.29. As long as we're in this box, I think that IWM is kind of quote-unquote okay. Below there gets a little bit iffy, and I think we would see a 50 MA test and a channel low test. So these 114s are going to be key this week. The Qs, a little bit more suspect, lower high here. We didn't take out the high of the range like we did in SPY. We had a 38.2 test. I don't really use 38.2s, by the way. I think they're... I use them on the opposite side. If there's been a big decline, I use the 38.2 as a sell point, but I don't use it as a, as a buy point. Right on the 50 MA, you have a regression line down here near the 200 MA. I'd be an interested buy. If we lose the 50, I'd be interested in buying some put ratios for a play, like buying these and selling 2 times out of the money for a channel low regression line and 200 MA test. I think this just got like poor highs kind of, and it's just having some responsive pullback. This is really the key area though, the 105s, 104, 105s. I've said that for a while. They held here like a champ. We couldn't push higher, which is an interest that could be an early warning sign, but I will still think that the channel holds at least for a kind of day trade play, like a bounce. Obviously, the stock that is going to matter the most for this is the Apple. Yeah, so this got up to the 100.72. I'm sorry that this is actually my real chart. Keep that in mind. We got, I don't even know if this spike here was real, but whatever, it stalled right where it should have anyway. 100.72, this got 100.73. I talked about that being an area to kind of book the 50% fib. Pulled back and now just kind of chopping below the 50. I would say that if you can get back up above the 100.72, you'll see the 103s to the gap fill to the 100. See 103.12 to 103.74 is a key area. 103.60 is the 61.8, and the full gap fill here would be 104.35. I don't know if I would play for 104.35, but I would definitely be playing for the 61.8 if we do get a move up over this. I would say that that is also kind of would be more bullish for the market. Monday, I think, is the beginning of the Worldwide Developer Conference. We'll see how that goes. I'm a little iffy with Apple just because of the just because there's another quarter coming ahead of the iPhone 7, so they just might have one kind of junky more quarter. That if they have a big move down ahead of that, I would say that that's a little bit more of a buying opportunity. I just want to flip over with regard to one more thing I wanted to add in about SPY, not to be too all over the place here, but this move down, which got everyone a little nervous. Take a look on the grid. I was talking about ticks. I don't know what the hell happened here. This got a little cray-cray, but look at this. We didn't even have one minus 1,000 tick on Friday. If we had plus 1,000 ticks, but the lowest tick, even in this kind of dump, was minus 997. That shows you, one, that there's not a lot of heavy selling. We did have some kind of trend day like breath. That's why it was a little bit weak, although we didn't close. We closed basically right on the VWAP. We are having a little bit of weakness, obviously, in Sunday night trading. It doesn't surprise me, considering we had a bit of a run-up here. The lows were a little bit poor, and we have some terror fears, so probably weighing a little on the psyche. I think there's not a lot of people also who want to jump in front of the Fed and Brexit or whatever that's coming up, but we'll see how that plays out. Facebook, this is a very interesting pattern. I've talked about this consolidation. This is looking very much the same. These usually tend to end in breaks that get trend tests. We have a gap fill, a 200 MA fast approaching. So I'll say this. If you're long, 50 MA is your must hold. 116s to the 50 MA. Anything below there to me is going to get a little iffy. I like it for row long against the 50, and I also like it for row short against the 50. You take it as you will with that. So that's the story with that. I wanted to talk about a stock I was long and then I sold, this Restoration Hardware. I had played it for a long down, I think it was on this trend snap. I don't remember exactly where it was, but it was really near the lows. It ran up I often say when you have that grind up type of a move after a protracted down move and you get into earnings. This had the gap below here and we're basically down to the 26s. The bad news is that this is still trading at like 12.5 times earnings. If this goes a little bit lower and starts getting below 10 times earnings, I will be a likely buyer. I have to do a little bit more Fibonacci analysis on this, like project some Fibonacci extensions down. But right here you can see I was thinking that there could be some type of a bounce. It never even materialized. There was never a trigger over the high of day here. It just wound up being a dump. So not surprising. We'll see how that goes. Another one I played, I still have a little bit on, is this Pay. I bought it down here. It rallied up quite nicely. It is now below that day. This could be a stop out very quickly. 19.5 was the after hours low here. Anything below there to me is just GTFO, particularly if it's below 2014 to 19.5. It's just GTFO. No reason to be involved. If this can hold and rally, then maybe it's a hold. I've been wanting to make these videos a little bit shorter. A lot in the market is going to really depend on the broad tape here. Let me go back to SPY. So when you're in a bit of an up move like this, you're in what I refer to as an actualizer market. If you want to Google that, I think you'd find that term interesting. When you're in a down move and things start getting squirrely, I would say you want to probably be a little bit more tight with your longs, but I really don't necessarily think we're in full apart mode. I just want to leave it on the fact that I'm looking at these support levels and I just go by the levels. 50 to 61.8 I really think is probably the max of this move. That would be a lot considering we closed at 21.10, but it's been a pretty big run. I think that would be a healthy level to pull back. And I still think we're in BTD mode as long as we're holding above 208.97. Below there, I'd be a little bit more iffy. Let's just keep it simple, stupid. Anyway, I'm going to leave it there. I was trying to make this video about a half an hour. We're a little bit over that. I will, if anyone has any more comments or questions, I am available on the stream. You can follow me at Justin Pulitzer. That's my Twitter handle. Please hit the subscribe button. That will get you notifications when I post new weekend review videos or Periscope rebroadcasts. Anyhow, that's my story. I'm sticking to it. Let's have a good week and cheers.